Chapter 4. Investment. Concepts and types. Investment is the process of allocating resources, usually capital, with the expectation of generating income or profit over time. It forms a cornerstone of financial planning for individuals, businesses, and institutions. The concept revolves around balancing profitability and risk, understanding how capital moves between asset classes, and employing strategies that maximize returns while minimizing exposure to potential losses. The concept of investment. At its core, investment involves putting money into ventures, assets, or financial instruments that are expected to yield future returns. Common types of investments include equities, fixed income investments, real estate investment trusts, REITs, mutual funds, and exchange-traded funds, ETFs. Each of these carries unique risk levels and potential rewards, necessitating careful consideration of how capital is allocated. Asset allocation, the process of spreading investments across various asset classes, is a fundamental strategy for balancing risk and return. Types of investment. Investors have a wide array of choices, each with different characteristics and financial outcomes. 1. Equities and blue-chip stocks. Equities represent ownership in a company, while blue-chip stocks refer to shares in well-established and financially sound corporations. These can offer capital appreciation and dividends, but they often come with higher market volatility compared to fixed income investments. 2. Fixed income investments and bonds. These provide a steady income stream with lower risk, making them suitable for investors who prioritize stability. 3. Mutual funds and ETFs. Both pool resources from multiple investors to purchase a diversified portfolio of assets. ETFs, in particular, trade on stock exchanges like individual stocks, offering liquidity and diversification. 4. Commodities and derivatives. Commodities include physical goods like gold and oil, while derivatives derive their value from underlying assets. Both can hedge against inflation and provide opportunities for speculative gains, but they also carry higher risk levels. 5. Real estate investment trusts, REITs. REITs enable investors to gain exposure to real estate markets without directly owning property. They often offer steady income through dividends and potential for capital appreciation. 6. Venture capital and hedge funds. These options cater to more sophisticated investors. Venture capital provides funding to startups and early-stage companies, often with higher risk but substantial growth potential. Hedge funds use complex strategies, including short selling and leverage, to generate returns and may appeal to those seeking alternative investment approaches. Balancing profitability and risk. Every investment decision involves weighing profitability against risk. A high return on investment, ROI, often comes with increased market volatility. To manage this, investors use various strategies. Portfolio diversification. By spreading investments across different asset classes, industries, and geographies, investors can reduce the impact of poor performance in a single sector. Risk-adjusted return and Sharpe ratio. These measures help investors understand whether the potential returns justify the risks involved. A higher Sharpe ratio indicates better risk-adjusted performance. Compound interest and dollar-cost averaging. Reinvesting earnings, compound interest, and consistently investing fixed amounts over time, dollar-cost averaging, can mitigate the effects of market fluctuations, allowing for steadier long-term growth. Capital movements and global impacts. Capital moves dynamically between asset classes, sectors, and global markets. Shifts in economic conditions, interest rates, and geopolitical events influence these flows, affecting both profitability and risk. For example, during times of economic uncertainty, investors may shift from equities to fixed income investments or commodities to preserve value. Conversely, in a bullish market, more capital may flow into venture capital and equities, driving higher returns but also introducing more volatility. Investment is not just about seeking returns, it's about understanding and managing risk, allocating assets wisely, and using strategies that align with personal financial goals. By considering factors such as market volatility, risk-adjusted returns, and portfolio diversification, investors can strike a balance between profitability and risk. Whether through blue-chip stocks, mutual funds, REITs, or commodities, a well-informed approach to investment can help secure financial stability and growth over the long term. Portfolio diversification. تنويع المحفظة. Capital appreciation. زيادة رأس المال. Dividends. توزيعات الأرباح. Asset allocation. تخصيص الأصول. Hedge funds. صناديق التحوط. Exchange traded funds. ETFs. صناديق الاستثمار المتداولة. Mutual funds. صناديق الاستثمار المشترك. Fixed income investments. الاستثمارات ذات الدخل الثابت. Equities. الأسهم. Blue chip stocks. الأسهم الممتازة. Venture capital. رأس المال المغامر. Real estate investment trusts. REITs. صناديق الاستثمار العقاري. Commodities. السلع. Derivatives. المشتقات. Risk adjusted return. العائد المعدل حسب المخاطر. Sharpe ratio. نسبة شارب. Market volatility. تقلبات السوق. Return on investment. ROI. العائد على الاستثمار. Compound interest. الفائدة المركبة. Dollar cost averaging. متوسط التكلفة بالدولار.